Billabong shares are riding the crest of a wave, jumping nearly 60% in 2 trading days on news the private equity firm TPG Capital is mounting a takeover bid for the embattled surfwear retailer. It's the latest in a string of high-profile companies that have been targeted by private equity, which is enjoying something of a renaissance despite lacklustre markets and the high cost of credit. Neil Woolridge reports.
Surf's up, and now TPG Capital is trying to catch Billabong's wave. The private equity firm has launched a fresh $3 per share takeover bid, which Billabong's board will now consider after last week rejecting TPG's earlier proposal.
With some of the changes we've made today and the strengthening of our balance sheet, we're very well positioned to begin to see quite strong growth.
It's a welcome piece of good news for Billabong shareholders who've seen the company's share price tumble from nearly $18 5 years ago to $1.75 before last week's announcement of a profit dive, job cuts and store closures. Like Billabong, the clothing maker Pacific Brands and the food and clothing services group Spotless have fallen out of favour with investors. Yet all three are in the crosshairs of private equity firms.
I think some of the brand names and shops that have made money in the past will struggle to do so in the future, and I just wonder whether some of these private equity firms have actually worked that out.
So many people say we've never had it so bad and life's tough. We've never had it so good in Australia, let's be honest. Compared to the rest of the world, our economy is very strong.
There's even speculation Wesfarmers might be broken up, with private equity firms picking up chains like Bunnings, Target or Kmart.
But Wesfarmers, because it is one of the last conglomerates in the Australian market, is always ripe for a breakup, because there'll always be times when the market doesn't reflect the value of all the different units added together. Having said that, the people that run Wesfarmers run a tight ship, and I just think it would be too big a bite for private equity at the moment.
Catherine Woodthorpe says private equity firms are suffering from tighter and more expensive credit markets, but she rejects suggestions that PE floats don't work out well for secondary investors, pointing to an industry study on comparative returns.
The PE-backed ones did better on every time horizon, whether it was 1, 3, 5 or 7 years. So the good things that private equity do with companies in terms of tightening them up, putting good structures into place, good governance, good strategies, all of that was flowing through for some years afterwards.
You can prove whatever you want if you're selective enough about the database you're looking at, but in the real world right now, no one wants to buy a private equity float.
Meaning that private equity firms may need to hold on to their current investments for some time yet.